If you're somebody who's thinking about becoming a day trader for income, vertical spreads might be something to look at. We're just going to be doing a basic video on how to trade put verticals. This is pretty much put vertical 101 in conjunction with trading happytrader.io, sentiment AI with Illumitrend, our indicator. Now you see it, now you don't, now you see it again. You can see our beautiful uptrend and downtrend signals there. And you can trade on any time frame, on any ticker. It's really nice to be able to do. But in this particular video, we're going to focus on the SPX as the instrument to trade. We're going to be focusing on 0 to 1 DTE because that seems to be the most popular way that folks and institutions are trading these SPX, NDX, and Dow indices intraday. I mean, it's becoming so popular. It used to just be niche and really small, but now it's getting big. I'm going to go over with you how happy trader signals can help you determine which legs to put on and when. So we're going to be using just the 5 minute chart. And, we had a big holiday on Monday. We had a sell signal with a downtrend, and then we proceeded to sell off. We're going to go back just slightly in time. And, you can see that we have our uptrend and downtrend signals. Now, these buys and sells do not trade off of these directly. These are going to be potential trend reversals. They have nothing to do with our actual trading signals. So uptrend and downtrend are going to be what we backtest on, and you can see that when we pull up just a random backtest, it'll superimpose there. So we do backtesting to make sure that our signals are optimized, and you can see on our other videos that they certainly are. Now, as for the put vertical spreads, why would you want to trade them? Well, they offer a nice income. So if you're somebody who's thinking about becoming a day trader for income, vertical spreads might be something to look at, or it might be something worth taking a gander at. Now, some of the positives about vertical spreads are that you're going to have a capped loss. So you do have to be careful about spread stops. If you're putting stops on a spread, like I'm going to show you exactly what that is if you do not know what a spread is. You need to make sure that you are aware that a lot of brokerages are not guaranteeing stops on spreads, and it's because of the interplay between the option that you sell, which you're collecting theta decay on, let's say it's here, and then you're going to go slightly above that to buy an option, and that caps your loss to the difference, right? Minus the premium received, of course, you're going to always keep your premium up front. So that's how that works. So as far as putting on the trades, the best way to explain this to you is to show you on the options chain. Now we're just going to pull up an E-Trade options chain. We're going to delete our strikes. Today's expiration is going to do us no good. I mean, we can look at it real quick and you can see that everything out of the money expired worthless at the end of the day. And that's just the way it goes. And everything in the money expired with intrinsic value. So you can see that, not too bad, right? Intrinsic value is a good thing. So if you're making a trade, if you're selling premium, you don't want your trade to go in the money. So I'm going to show you just an idea of how I like to trade vertical spreads and when I actually like to trade them. So let's say, for instance, on a random day, we're looking at the 5 minute chart on the SPX. Happy Trader shoots out a downtrend signal. Well, we have a couple options. We can just take, maybe some SPY stock short and we can hold it and it's going to gyrate around and, we're getting the signal here. It's going to pull back a little bit and then bang, it drops. It doesn't always do that. Sometimes it's going to be a scalp. Now, in a situation like this move right here, this might make more sense to make a theta play. So if you're looking, let's just say the indexes are all down for the day. Let's also go over to the vol-D. Let's look at the advanced decline volume, and you can see it is down and negative for the day. It really just hovered in the negative, and it tried very hard. I mean, it got over the hump, and then it just, got rejected there. So let's go back to the SPX. And with all those things in mind, and then also combined with the fact that crypto is not doing too much, kind of flattish, I'd be leaning on the bearish side of things. Now, if you want to sell a call vertical spread that is bearish, this is how you would do that. So I'm going to set this trade up as an income trade so you can see what I'm talking about. We're not going to be looking at today's expiration. The market just closed, and we are going to instead go to the options chain for tomorrow. If we see this downtrend signal, the idea behind the call credit spread is going to be to get out of the way of all of the immediate chops. So it's not like trading futures. It's not like putting stock on and watching it immediately go against your position and just gyrate around until it figures out which way it wants to break out. When you're selling options, it works a little bit differently, but there is different sensitivities to the underlying as well as different means of control through delta of the underlying itself. So you have to be cognizant of what you're doing. So let's say we get a downtrend here. We have a pretty good range and we want to kind of like, we want to get up into this zone a little bit, right? Let's go to the options chain and see what we can come up with. So let's say, just for example, we're looking at tomorrow's premiums, okay? So we're seeing right now that the S&P 500 it lost 5,000, okay? So that's a big deal. Now is it going to try to retest 5k by the end of the week? Probably. I think so, but you never know with the market, right? The market's random. So what can you do? You can make a theta play here. You can also make a defined risk theta play that'll still potentially make you income and one that can be traded and scaled. And I'm going to show you how that works right now. So what I like to do is first I like to figure out what side I'm going to sell on. So it's going to be the call side. If we have a downtrend signal on Happy Trader, and if we don't have Happy Trader, we really don't know. We might have sold the put on this up move, but because we have Happy Trader, we have a little bit of that heads up going on. So I'm looking 100% to sell a call vertical based on our back testing and how accurate Happy Trader typically tends to be. So again, this is not financial advice. I'm not telling you what to do, but this is how I like to trade the put vertical. So it's going to be a call vertical on this trade. So we're going to go into our options chain and we would say, hey, we want to sell a call vertical. And this would be like intraday, right? Overnight risk. You got to be careful with that, especially if you're selling options or selling spreads. But, the first thing you want to do is really just kind of like look around for some meat on the bone while staying further out of the money. So if we're at 49.75, let me scooch this over just a little bit. We're at 49.75. We could sell a 50.15. We could sell even further out of the money. We could sell, this one here, the 50.20. The market would have to move quite a bit to breach a 50.20. But for the sake of this video, let's just pretend that, we want to target about $100 of premium. So we're going to go and do a 50.15 to 50.25. So we'll do a 10 wide. So we're selling above the market at the 50-15 range. Now the prices aren't going to match up because we are looking at a previous downtrend signal. The market's currently right here, so just bear that in mind as we're looking at our trades. So when we go to put on the trade, we're going to just do a simple 10 wide. We're going to sell the 50-15 call, and then we're going to buy, to make a spread and to cap our loss. And you can see that at the bottom there. Our max profit is the premium collected, $105. Our max loss is going to be $809. Now, we can make this even better by kind of customizing it. We can look at it. We want to make sure our strikes match up, our number of contracts match up, and we want to look at our snapshot analysis. And you can see that the price of the underlying security, which is the SPX, is right here on this dotted line. You can see that we're already winning this trade just by putting it on, and that's why we have an 89% probability for maximum profit to get that full $105. Now on the flip side, there's a 5.62% chance that we might lose up to $895. So how do you mitigate that? One really good way to mitigate that is to use a stop loss. So you could use a 1x stop loss. So if you hit 105 as a loss, you could just kill the trade and then enter on another signal, call it a day. If you lose one and win one, that's going to be a scratch if you're collecting the same premium. So again, for Happy Trader, it's very versatile. You can go all the way down to the 3-minute chart if you want. You're going to get more signals there. If you like the 1-minute chart, you're going to get even more signals there. So it depends on, kind of your risk appetite, your volatility, whether you're a swing trader. This is the 15-minute chart. You're going to get some nice cleaner signals here on the 15. So, once you determine your trade, you can set a stop loss. And normally the way to do that is just to edit the ticket, and you would bring up a new ticket after this trade is put on. You want to try to collect the mid price if possible. If you need to collect a little less, you can go down one tick and you could just tick that down one tick to $5 less, and more often than not, you're going to get filled, or you're just patient and wait for the mid price to fill. Now, you're going to be collecting a credit, meaning you get this credit immediately in your trading account. So your max loss is the difference between these two strikes minus the credit received. Okay, so that's going to be your capped loss. And you can see that the probabilities are super high that you're going to win this trade. You're already in the money. So the worst thing that can happen is before the expiration date, which would be tomorrow, if we're trading, let's pretend today is tomorrow, we're trading intraday. The time to get worried is to maybe, think about putting another side on. If you want to add a put side, you can subscribe, look at our Iron Condor video that we have that explains how to put both sides on and also make adjustments. We can go further into that on another video, but right now we're just doing directional. So you're in this trade. You could set a 1x stop for $105. You could set a 1.5x stop. And what this is going to do is make your win rate just slightly over 50% in back testing. So you're going to lose a lot more trades than you win, but your winners are going to outsize your losers when you use a 1 or 1.5x stop. Now, if you go out to a 2x stop, a 3x stop, you're still going to be under your max loss. You're going to be maybe $400 maximum, barring slippage. But to not hit that max loss, it's really simple. You just put the trade on and you're putting it on for a credit. You can take it off for a stop limit debit. It's not going to show stop limit debit, but you can put it on for your stop limit debit. And let's say we collected 105, we could just do 210 at a 1x stop, just for example. So that would be how you would put that trade on. And what happens is, how does this trade make any money? Well, you can see it in that snapshot analysis, right? So it's theta decay, right? So it's the decay of the market just kind of, not breaching right here, this corner. And that's going to be your key. So as long as this dotted line stays over this corner, if it stays to the left of this corner, it doesn't matter what happens intraday with this. So you could be taking drawdowns and then all of a sudden, boop, as the end of the day gets close, you're going to be in the green and good to go. Now, make sure you use risk management for these types of trades. Super important. And again, I'm not giving you financial advice. I'm just saying that I've seen these trades go south. So that's really going to be how to trade the put vertical using the happy trader signals. This is a great way to collect premium. $100 on one contract isn't too bad. And if you wanted to collect more, you can just raise the number of contracts to as much as you're looking to collect. So, it's scalable. It's something that can be done daily. We have all of our expirations, our daily expirations for the SPX, which makes it a perfect instrument. Now, the last thing I want to mention is assignment risk. You may or may not know this. With the SPY, which is 1/10 the size, you can be early exercised. You can be exercised 0 DTE trading quite easily when you are selling on the SPY. Now, there's one other instrument, 1/10 the size of the SPX. It's called the XSP. And in my estimation, I don't like the liquidity of selling spreads. I like the SPX. And, an option is to go further out of the money, collect less premium, but set that stop tight. Another thing that's important to do is monitor your trade. You don't want the market to suddenly move and then bust directly through your trade, breach a strike, and potentially blow up an account. So today's video has been on how to trade the credit spread. You can also do it on the put side. If you're getting uptrend signals, it's just inverted. So you'd sell a put vertical, you'd sell a put, and you would then buy a put a little further down. And that's how you can leg in alongside these happy trader signals. And even if you're not using happy trader, you can still leg in using whatever you use best. My name's Ryan. I'm the CEO and head quant at Happy Trader. Have a great day and happy trading.